You ever wonder how two YouTube channels can get the exact same number of views, but one creator's making way more money? It's one of the biggest puzzles on the platform, and today we're going to crack it wide open.
So picture this, two creators. They both grind. They both have a video pop off and hit 100,000 views. A huge win, right? One's in gaming, the other's in personal finance. On the surface, their success looks identical. But under the hood, their bank accounts are telling a completely different story.
That gaming channel? They might pull in about $300 for those views. Not bad. But the finance channel? A mind-blowing $5,000. That's not just a little extra cash. That is over 16 times more money for the exact same number of eyeballs. Wild, right?
So what gives? How is that even possible? Well, it's not about your view count. It's about your view value. And understanding that one little difference, that's the key to unlocking how the YouTube economy actually works.
All right, let's dive into our first section, decoding YouTube's economy. We're about to pull back the curtain on the so-called secret numbers that are really in charge of your paycheck.
Okay, first thing you gotta know is CPM. It stands for cost per mille, which is just a fancy way of saying the price an advertiser is willing to pay for 1,000 ad views on your content. Think about it. An advertiser who's selling a $2,000 investment course is going to pay a lot more to reach people watching finance videos than a company selling a $2 mobile game. It's all about the audience's buying power.
But here's the thing. CPM is what advertisers pay YouTube. What you really care about is RPM, or revenue per mille. This is your reality. This is the cash that actually hits your bank account after YouTube takes its 45% cut. So a $10 CPM for the advertiser usually works out to about a $5.50 RPM for you. The big takeaway is this: a higher CPM directly means a higher RPM. That's the whole game. So now that we know why the money's so different, let's look at where it's all going. Welcome to the 2026 niche gold rush.
Just look at the scale of these numbers. We're talking CPMs that can hit $55. Personal finance, legal, business, tech, and real estate. This is where companies with seriously deep pockets are in a bidding war for your audience. This is where those $5,000 paychecks are born.
But you know, finance is huge. So let's get really specific. High-value topics are hyper-focused on viewers who are ready to make a buying decision. Think titles like Best U.S. Credit Cards or Comparing TurboTax versus H&R Block. See? These titles attract an audience that advertisers are literally tripping over themselves to reach.
Okay, so the top niches are super competitive, I get it. But what if there were hidden gems out there? Fields with just explosive growth and almost nobody making videos? Let's go find one.
Would you look at this? The senior health and wellness niche. The competition level is practically on the floor. But the subscriber growth rate? It's 19 times the platform average. That right there, that's the sweet spot. You've got a hungry, underserved audience with huge advertiser potential. It's all about finding where demand is growing way faster than the supply of content.
But look, the smartest creators, the ones who are really building something, they know AdSense is only the beginning. Like the business strategist Adam Manfroy says, the real goal is to build a business around your channel. Ad revenue is great, but it makes you totally dependent on YouTube. Selling your own courses, your own templates, that's when you really take control.
And here's probably the most important piece of advice in this whole thing. Please don't just chase the money. Making content in a niche you absolutely hate is just a fast track to burnout. The real magic happens when you find that intersection of what you love, what you're good at, and what a high-value audience is looking for. That's how you build a real, long-term business. All right, now for the Tier 1 strategy. And this is a big one. It's why your audience's location can literally 1x your income. We've covered the what, the niche, now let's cover the who, and even more importantly, the where.
This is just the stark reality of the global ad market. Advertisers pay a huge premium to reach audiences in Tier 1 countries. We're talking the US, UK, Canada, and Australia, all because of their high purchasing power. The same exact view from a Tier 3 country can be worth 10, 20, or even 50 times less.
So, a top-earning channel's analytics, it almost always looks something like this. The vast majority of their audience is concentrated in those few high CPM countries. And believe me, this is not an accident. It is a very deliberate strategy.
And the good news is, you can actually do this too. It's about tailoring your content, using American English, referencing brands and topics specific to the US or the UK, and even timing your uploads for their peak viewing hours. These little tweaks send signals to the algorithm,
about exactly who your content is for.
Okay, finally, let's zoom all the way out and look at the bigger picture for 2026. Is this a boom, a bubble, or maybe both? We have to look at the massive economic forces driving these trends, because what's happening right now is pretty unprecedented.
The AI boom is pumping trillions of dollars into the market. I mean, just look at NVIDIA, the company making the chips that power AI. Its valuation skyrocketed from $1 trillion to $5 trillion in just over 2 years. That massive wave of cash is what's funding those sky-high CPMs for any content related to tech, software, and AI.
But there is a flip side. Some analysts are starting to sound the alarm. They're pointing to something called circular investments, where these huge tech firms are just investing billions in each other to create the illusion of massive growth. It's drawing a lot of comparisons to the dot-com bubble, and it raises a pretty big question. Is this boom really built to last?
Which leaves us with a final, crucial question for any creator trying to figure all this out. In the 2026 gold rush, are you going to be out there digging for gold, chasing the hype in these booming but maybe volatile niches? Or are you going to play it smarter and be the one selling the shovels that everyone